All right, Abhay Soi joins us, Chairman and Managing Director with Max Healthcare. Abhay, good morning. Thank you for joining us. In your numbers, we've seen a good jump in top line, but your margins have declined a bit both sequentially and year on year. Was it because of seasonality or largely because of new bed addition or some other factor?
Yes, so this is firstly, it's our 15th consecutive year-on-year, best performance. And this time around, if I compare it to my Q1 to the Q1 last year, you will see that there is a 6%, 7% increase in ARPOB, whilst the occupancy quite a bit remains the same. Now, what that does is that, down the line, it's essentially because we've done a better higher clinical mix, better payer mix, and so on. And that sort of translates into EBITDA per bed. So you have a 7 to 8% increase in EBITDA per bed as well. Now, one of the characteristics of doing higher end clinical programs is that your margins in percentage terms are typically lower. So the more robotics you do, the more high-end oncology surgeries you do, your percentage margins are lower, whilst the margin in quantum, in value terms, is higher. So as you're going up the clinical mix, your percentage margins will, sort of stagnate or sort of come down, whilst your EBITDA in value terms will go up. So, I would sort of encourage you to look at EBITDA per bed rather than EBITDA margins in percentage terms.
At Abhay, morning. Now, we've spoken a lot about your capex, but with the existing hospital network, occupancy is above 75, 76%. The ARPO, BOP is above 75,000 rupees. Do you think that there are concerns in terms of limited headroom for volume growth from these levels?
So honestly, our occupancy levels have not been below 74, 75% in the last maybe 10 quarters. We are operating at these high capacities, and therefore most of the expansions we are doing are brownfields. So there's less headroom for occupancy increase. Therefore, there is more headroom for ARPOB increase, and that's what we've been enjoying. But eventually, it needs to translate to better EBITDA, better profitability, and that is something that has been playing out. The last 3 months of this first quarter, we've added essentially 900 new beds, which is almost 30% of capacity addition in this quarter. Do keep in mind, we do not have these 900 beds in the last quarter of the last financial year. And the first quarter of in the current financial year, we've got these additional beds in the form of Lucknow, in the form of Nagpur. And then last 3 days of the quarter, we also commissioned Dwarka. The occupancy levels in these new hospitals is lower, it's about 60%. So there's quite a bit of headroom over there.
So you're focused mainly on Delhi and NCR. How are you looking at new clusters, further opening long-term opportunities? Could you give an example of Lucknow expansion? When could it kick in?
Well, we recently gone to Lucknow, Nagpur, and again in Mohali. I think we have existing hospitals. This is another opportunity that we've just signed up in a build to suit, which we announced. This is a 250-bedded hospital where a developer is developing this hospital to our specs. So the entire development risk is kind of insulated. We are insulated for any development risk, any time and cost overruns over here. So that's a new opportunity. Other than this, there are about 20, 21 cities, I always said, where at least 2 or 3 of our peers have proven viability. We're quite excited to look at opportunities over there as well, which we continuously continue to do so. We do have a balance sheet which is debt-free. So, even if we were to prudently leverage it to 2.5 times debt to EBITDA, that will give us about close to 7,000 crores of free cash flows for further investment.
Right. And finally, the company has also showcased pretty strong, consistent education in existing clusters with the best-in-class margins and ROCEs. But given that you're expanding, how are you looking to continue to maintain these costs?
So 85% of expansion is through brownfield. So you can imagine existing building, which is fully occupied, and you put 2 or 3 more floors on top of that. Your costs are already incurred by the existing building. So the new beds, the new floors will always have extremely high EBITDA because you have very good operating leverage coming through over there. Your fixed costs, everything else is already incurred. Your management cost is incurred, your clinician cost is incurred, and so on and so forth. And more importantly, you're putting up those beds because you run out of capacity. And that is something that you were alluding to at the beginning of the conversation, that, capacity, your hospitals are capacitied out. And that's the reason we are putting it. And therefore, we don't see costs go up. We see them break even almost immediately.
All right. Thank you so much for joining in. Good to have you on board.